Everybody is wrong. I mean, they're more wrong than they were in the summer of 2008 when everybody thought it was a Goldilocks economy. And we were in the worst recession since the Great Depression. Remember, that depression or that recession started in December of 2007. But the government didn't acknowledge its existence for a year. It wasn't until December of '08 that the government said, you know what? We've actually been in a recession for an entire year. And in fact, it's the worst one since the Great Depression. So all the economic data that we've been spoon feeding the markets for the past year has been wrong. And everybody who thought we had a good economy based on that data was wrong. In fact, we were in a severe recession and we had a financial crisis. I think the economy is worse now than it was then.
In this video, Peter Schiff delivers a stark warning about the current state of the economy, challenging prevailing optimism in the markets. Drawing parallels to the period preceding the 2008 Great Recession, Schiff presents a compelling narrative supported by historical insights and current economic indicators. Schiff begins by pointing out the widespread misconception about the strength of the economy, emphasizing that economic data has often been misleading. He recalls how the severity of the 2007 to 2008 recession was not acknowledged by the government until a year after it began, highlighting the dangers of relying solely on official economic reports. According to Schiff, the economy is now in a worse state than it was before the 2008 recession. He coins the term Greater Recession to describe the expected severity of the impending downturn. Schiff identifies persistent inflation, high consumer borrowing, and significant government spending as key factors contributing to the economic challenges ahead. Contrary to the belief that inflationary pressures are easing, Schiff argues that inflation remains a significant threat. He points to recent Consumer Price Index (CPI) data and trends in commodity prices, such as oil, as evidence of ongoing inflationary pressures. Despite the Federal Reserve's interest rate hikes, consumer borrowing and spending continue unabated, highlighting a disconnect between monetary policy measures and their intended effects. Schiff critiques the Federal Reserve's strategy in handling inflation and economic growth, suggesting that the central bank is in a dilemma. While it needs to raise interest rates to combat inflation, doing so risks triggering a severe recession due to the fragile state of the economy. Schiff believes this predicament exposes the limitations of the Federal Reserve's policy toolkit and warns of the potential for a crash landing instead of a soft landing. Moreover, Schiff argues that expansionary fiscal policies, marked by high government spending and deficits, are exacerbating the inflation problem rather than alleviating it. He criticizes the government's failure to implement contractionary fiscal policies in response to inflationary pressures, highlighting the contradictory nature of fiscal and monetary policies.
I think the recession that we're going to be living through, and it's probably already begun, is going to be far worse than the Great Recession. So it's going to be a greater recession. And what's going to compound the problem is going to be inflation, which is not dead and buried, as the markets believe. It's alive and well. And today's numbers from January CPI, support that view. Inflation is headed back up. In fact, if you annualize the core number that came out today, it's 5%. The headline is running closer to 4%. I think it was 3.7 if you annualize it. But look at what's happening to oil prices. They're moving back up. Bond yields are rising sharply again. But I think the real key is that the Fed's rate hikes did nothing to reduce consumer borrowing or spending. Consumers continue to spend and borrow. Even though credit card interest rates are at an all-time record high, they're above 20%, credit card balances are at an all-time high. Consumers are not responding to higher interest rates by reducing their borrowing and spending. And they're not saving more, which is what they have to do. Savings is still falling. And look at the government. Government budget deficits are rising in the face of rising interest rates. So the government is not cutting back on its spending. So the Fed has done nothing to put out the inflation fire that it lit. So the markets have got this thing totally wrong. There is no soft landing. There's a crash landing. In fact, the markets don't even think there's going to be a landing. They think we've avoided recession altogether. But we're going to have a severe recession, depression, if we're not already there. And inflation is going to get worse the entire time, which is going to not only compound the severity of the recession, but expose the paper tiger that the Fed is, because the Fed is not going to be able to raise interest rates in the face of a resurgent inflation because the economy can't handle it. I mean, I think that's the main reason that Powell pivoted. It's not because he won the inflation fight. It's because he realized that if he kept fighting, the economy would be the collateral damage. We'd have a financial crisis, and everything would collapse beneath the weight of those rising rates. We've had an easy policy, an inflationary policy the entire time the Fed's been tightening. I mean, yes, the Fed has been less loose, but I don't believe that less loose constitutes tight. But the entire time the Fed was being less loose, the government was loose. I mean, because you have an expansionary monetary policy. Even if you look at the Keynesian textbooks, which, are worthless, but even according to Keynes, if you have an inflation problem, the government needs to raise taxes, cut spending. It needs to have some type of contractionary fiscal policy. The type of fiscal policy that we've been running for the entirety of the Fed's inflation fight has been the classic Keynesian stimulative policy that you're supposed to run when your problem is recession and you're not concerned about inflation. So these have been diametrically opposed policies. And anytime Powell gets asked about it, or doesn't even get asked about it anymore, if he's asked to comment about these, government spending and budget deficits, he says, hey, I can't talk about that. That's not in my lane. He says, I'm only concerned about monetary policy. But he can't be, because the fiscal and monetary policy go hand in glove. You can't be oblivious to the spending, because the reason that, money supply growth or low interest rates, the reason that causes prices to rise is because it fuels demand and there's not enough supply. And so prices go up. But government spending also fuels demand. And so does credit. I mean, the entire time that Powell's been looking at interest rates, he's been oblivious to the credit markets because credit continues to expand. And if you go back to the classic definition of inflation, it's not just an expansion of the supply of money. It's an expansion of the supply of credit, because you can buy without money if you have credit. Credit can also fuel demand. And so we've been spending and spending. The only thing that really brought down the CPI was we had a huge spike, right? So nothing goes in a straight line, but it was the anticipation of the rate hikes that brought the dollar up. The dollar gained about 30% against, global currencies. That brought down import prices. That brought down oil prices. And that helped bring down headline number. But that's a transitory effect. I think oil prices have already bottomed and are turning back higher. And bond yields too. Bond yields came down. That helped bring mortgage rates down. But now they're going the other way. Bond yields are rising again. So that's going to put more upward pressure on rents, because now buying a home becomes that much less affordable. So all the factors are now operating in reverse, and the markets are completely clueless. They're positioned the wrong way. So we're in a very dangerous point for equities, bonds, everything, because everybody is betting on an outcome that is not going to happen.
In conclusion, Schiff emphasizes the dangers of misplaced optimism in the markets and urges investors to reassess their positions. He warns that the economy is heading for a severe downturn, compounded by rising inflation and ineffective policy responses. Schiff's critique of the current economic landscape underscores the need for a more cautious and informed approach to investing in uncertain times. If you found this analysis insightful, consider subscribing to our channel for more updates and commentary on economic trends. Your engagement and feedback are invaluable as we navigate the complexities of today's financial landscape.